Have you ever wondered why your grandparents could buy a house for the price of a used motorcycle today? Or why a dollar from the 1950s felt so powerful, while the dollar in your wallet now feels weak, fragile, almost insignificant? But here's the twist. The idea that money always loses value isn't the full truth. This belief, this global fear, this everyday complaint about everything getting more expensive, is only the surface of a much deeper story. Hidden beneath the rise and fall of prices lies a truth that economists rarely explain clearly. Money doesn't simply lose value. Money is designed to lose value by purpose, by history, and by power. Yet, there were moments in history when money didn't feel it rose. There were times when holding cash was smarter than investing, when prices fell year after year, and when ordinary people became wealthier simply by waiting. So is money losing value a myth? A fact, or something far more interesting and far more dangerous than either? Today, we rewind the story. Welcome to the Economic Rewind Vault, where we uncover the hidden history of the economy, gold, and money to understand the world we live in today. And before we open the vault, if you enjoy discovering the real forces behind the systems controlling your life, consider subscribing. It ensures you never miss an episode that might just change the way you see the world. For generations, people have repeated the same complaints. Things used to be cheaper. A dollar doesn't buy anything anymore. Everything is getting so expensive. Because everyone says it, we assume it must be true. But let's break this down. When people say money loses value, what they actually observe is simple. Bread costs more, rent costs more, cars cost more. The logic seems clear. If prices go up, then money must be going down in value. It feels simple. Most too simple. Because in reality, prices don't rise evenly. Some prices fall, and some fall for decades. And some prices only rise because of policy, not because of some unbreakable economic law. Most importantly, money is not neutral. It is a tool shaped by governments, central banks, war, debt, and history. To understand why your money loses value today, you must first understand why, for long periods in history, it did the exact opposite. Let's travel back to the 1800s and early 1900s, the era of the gold standard. Back then, the world operated under a simple rule. Money had to be backed by gold. This meant governments couldn't just print money freely. This created a world of stable, or even falling blue prices. For nearly a century, production costs were declining. Factories became more efficient, transportation accelerated, and productivity soared. As a result, prices dropped year after year. In the late 1800s, the longer you held your money, the stronger it became. Not because interest rates were high, but because deflation falling price increased the purchasing power of every single dollar. Farmers who saved became richer annually. Workers could buy more food the next year than the previous one. Shop owners didn't live in constant fear of rising costs. During this time, money was actually gaining value. So, does money always lose value? Clearly not. But then, a dramatic shift occurred, one that rewired the entire global financial system. Two dates changed the destiny of money forever: 1913 and 1971. In 1913, the Federal Reserve was created. Its stated mission was to stabilize the economy and prevent financial crises. But it came with a powerful new ability: the power to expand the money supply intentionally. Then came 1971, when President Richard Nixon slammed the gold window shut, ending the direct convertibility of U.S. dollars into gold for foreign nations. From that moment on, money became pure fiat-backed by nothing but government authority and trust. The natural limit on printing money was gone. Inflation became a permanent, expected feature of the economic system. After 1971, the economic world transformed. Housing prices skyrocketed. Food prices surged. Oil prices exploded. And for many, wages failed to keep up. In the decades since, the dollar has lost more than 85% of its purchasing power. This is where the modern myth was born. Not because money always loses value, but because we now live in a system that is engineered for money to lose value continuously. But why would governments want your money to lose value? The answer is surprising and a little uncomfortable. First, inflation is a silent way to reduce national debt. If a government owes $1 trillion and inflation rises, the real value of that debt shrinks over time. A $100 debt in 1950 was a serious burden. That same $100 debt today is almost meaningless. Inflation erases debt without anyone noticing. Second, inflation encourages spending and discourages saving. If you know prices will be higher next year, you're more likely to buy, invest, and consume today. That constant movement of money is what keeps the modern economy churning. Third, inflation makes wage adjustments politically easier. Instead of cutting salaries outright, which causes outrage and protests, governments and companies can allow inflation to quietly reduce purchasing power. No headlines, no anger, just a silent loss. And fourth, inflation helps keep the stock market rising. As money loses value, assets priced in that money like stocks and real estate appear to go up. The economy looks strong on paper. Even if the foundation is shaky, it's wealth by illusion. So Yashura money doesn't lose value by accident. It loses value because powerful institutions prefer it that way. But here comes the final plot twist. Even today, in our current system, there are moments when money gains value. During recessions, market crashes, debt crises, and banking failures, what do people do? They run toward cash, not away from it. They rush to hold dollars, stable currencies, and government bonds. In moments of extreme fear, cash becomes king. Money becomes a shield. Holding dollars provides safety. This is why, during the 2008 financial crisis, the US dollar actually surged in value even as the Federal Reserve was printing money at historic levels. Fear made money powerful, while confidence made it weak. This is the paradox most people never recognize. So after rewinding the entire history of money, what's the final verdict? Does money always lose value? No, it didn't under the gold standard. It didn't during long deflationary era, and it doesn't during moments of financial panic. But does money usually lose value today? Yes, absolutely. Because today we live in a fiat system, a debt-driven economy, and a world where a low level of inflation is intentional policy, not an accident. It's a world where the system is designed to reward the ownership of assets, not the saving of cash. So the myth is both true and false. Money loses value within the system we have created today, but it wasn't always this way, and it doesn't have to be this way forever. If this perspective changed how you see your money, consider subscribing to the Economic Rewind Vault. Not for the numbers, but so you don't miss the next chapter in the hidden history of finance. Every episode makes you just a little bit harder to fool. And in the next episode, we uncover one of the most dangerous beliefs in modern finance. Gold is the safest investment. Is gold truly the ultimate safe haven, or is it the most misunderstood asset in history? It's a story of war, panic, manipulation, and survival, and trust me, you will never look at gold the same way again. See you in the next rewind.